All right, underperform rating, $6 price target. That is what Macquarie analyst Chad Beynon is thinking about shares of AMC right now. In a recent note, looking at the overall movie industry. Let's bring in Chad right now to talk more about this call. So Chad, let's just start with the vision that you guys have for AMC right now and the fundamental kind of backdrop that you are analyzing AMC against and how you're getting to $6 a share.
Thank you. And thank you for mentioning the fundamental case here. So fundamentally, we had been calling for the box office in the United States to recover back to pre-pandemic levels, really at the beginning of 2023. And we thought that 2022 would only be down mid to high single digits. We've recently become a little bit more negative in terms of the pace of the recovery. So for this year, we're expecting the third quarter to be down 50%, fourth quarter down 35%. Next year down around 15. And then in 2023 versus pre-pandemic, we still expect for box office admissions to be down 8%. And what the companies are doing to combat that negative admission trend is they're actually seeing really good trends in terms of pricing on ticket price and on concession sales. But for companies like AMC, we think they're going to get hit with the same inflationary pressures that others are seeing in the industry. And we just don't think there's a fundamental picture. We have them losing money in 2022. And then from our valuation standpoint, we're looking at 2023 free cash flow to arrive to our $6 target.
And, Chad, in the last segment, we were just looking at a couple of major releases from Paramount getting pushed back, another 6 months or more, depending on the exact film. I mean, is there still perhaps in thinking about the movie business? You look at what's happening with the way HBO Max is treating some films, Disney Plus is treating some film, Paramount Plus might be treating films differently. Is there still not really, let's call it a floor on what the box office baseline looks like on the other side of this? Because we are benchmarking to incredibly strong years for the industry, 17, 18, 19. And I do wonder if we're still not rationalizing what a normal, quote unquote, normal box office looks like, 4 or 5 years out.
That's exactly our thinking. Look, I think most studios do believe that they'll get back closer to this 45-day window at the box office instead of the day and date. Movies that have been released at the box office and simultaneously at the home have not done very well during the past couple of weeks. Movies that have a 45-day window have done a little bit better, but still not back to what we were seeing before. And then we look at trends that we're seeing at malls, theme parks, casinos, travel. So many sectors are back to pre-pandemic levels. And the fact that admission revenues in the United States are still 50% of what they were. Now, I understand, kids aren't vaccinated, so a lot of those G and PG movies aren't seeing much attendance. But still, for a good movie with PG-13 or R-rated, we're just not seeing the demand that we were seeing before.
Chad, hang with me on this one. So I was a one-time stock analyst, covered retailers, many retailers for many years. I made some aggressive calls, but I never got a response by the similar responses that I'm getting when I tweeted out your note from AMC. There's a very passionate group of people here, I would say retail investors following AMC. As an analyst, what is it like right now to cover this company? Are you getting emails from, really AMC believers? Do you get notes written to your house? Like, how difficult is to do what you're doing here?
Thank you for that. Yeah, it has been a pretty difficult time. I think, the AMC story is really momentum and technically driven. And a lot of the leaders of this following have highlighted that this is a really good time from a technical standpoint. And a lot of people are calling for a breakout. And, some believe that the stock can get to 100, some believe it can get to 100,000. It has outperformed other meme stocks, and it sounds like there has been some consolidation. However, we do think after Labor Day, when some of these investors are back at work and maybe, they're looking at other things, maybe they're gambling on sports, which will be on this weekend and next weekend, maybe the bloom comes off the rose a little bit. But yeah, certainly there has been a lot of negative feedback. A lot of people just kind of go back and say the fundamentals don't matter. But, we think they still do. And we think at some point, the meme stock rally or the technical, factors that everyone loves about AMC might become more attractive on other names. So when that happens, that's when we think, a lot of the AMC investors could move into another name that they find more attractive. And then the fundamentals will matter.
And then, Chad, just finally, just to close the loop on this note, I mean, you guys are out with an outperform on Imax and on Cinemark. So there are names in the movie business that you like. What are those two, chains doing differently that gives them a little more visibility to some stronger performance here, as the industry recovers, but perhaps as we've been discussing at a different pace than maybe some had hoped?
Yeah, so we really like Imax. Imax is a global company. About a third of their business comes in China, a third rest of the world, and a third domestically. The 45-day window doesn't hurt them as much because movies in an IMAX screen are generally there for 1, maybe 2 weeks max. Secondly, they get paid on the projectors that they place into AMC theaters and Regal theaters and Cinemark theaters. And they have a huge backlog that should be monetized over the next 24 months. So that's money that's just kind of an inventory right now that they will receive. They have a clean balance sheet as well, and the valuation is cheaper than what we've seen over the last couple of years. For Cinemark, more of a traditional exhibitor, similar to AMC or Regal, they historically have just generated significantly higher margins. So margins of 20 to 25% versus AMC, which is 10 to 15%. Rent less than their screens as a percentage of total revenues. We think they're just in better markets. They have good growth, and they also have a great balance sheet. So I'd say it's balance sheet, operations, and really, just kind of a catalyst going forward. Cinemark also was the leader in terms of dividend paying. They had a really good payout ratio. I think they can get back to that, and that'll start in 22.
All right, we'll leave it there. Always appreciate the time, Chad Beynon with Macquarie. Chad, I know we'll talk to you soon.
Thanks, guys.
The pandemic has generally lifted the financial fortunes of many players in the fast food industry. Households have gravitated to eating more at home and have favored the contactless experience of drive-thrus. Let's check in to see how Checkers Drive-In Restaurants is faring right now. Francis Allen is president and CEO and joins us now. Francis, good to see you here this morning. Look, you are primarily a drive-through oriented business. You have the outdoor seating. So that is, I suspect, had been a tailwind to your business. How are sales right now?
We're doing very well. Q2 on a 2-year basis, we were up 17.8% versus 2019. So having a very strong, we had a very strong 2020. We outperformed the competition by 600 basis points, and it's looking good in 21 so far.
And Francis, thinking about some of those trends, we've talked to a lot of folks with the amount of exposure to consumers that certainly you guys are going to have. How do you view the state of the consumer today? We've seen some of the stimulus start to expire. We know consumers are sitting, on a lot of savings. Does the sell-through today indicate to you guys that there is still, kind of a strong demand out there across the board from folks?
Look, we definitely see an uptick when those child tax credits go out each month, and certainly the stimulus earlier in the year. I think that we are a brand that is all about craveable food, affordable food. So we've seen a kind of continuous demand for our product. We also had already, prior to the pandemic, lent into delivery. And we saw our delivery business double. So I think we've got a lot of new customers coming in. We estimate about 50% of the people that have tried us on delivery are new customers to the brand, which is fantastic. We also have a double drive-through. So we were able to convert many of our drive-through lanes to be dedicated delivery lanes. So that actually creates a much better guest experience and a much better experience, importantly, for the drivers.
Francis,
in addition to that...
Oh, go ahead.
I was going to say, in addition to that, we launched a loyalty app in January that has an order ahead feature. So we're seeing good uptake of that as well.
I was just going to say, Francis, that Checkers behind you in your background, that does not look like the one by me in Long Island, New York.
Yeah.
Have you come out with a new concept and a redesign?
Yes, this is our new restaurant of the future. We are very excited about it. A lot of work has gone into both what the guest experience, but also the employee experience. So within this new design is a brand new kitchen, which makes it much easier for our crew, which is critically important right now. We all know what's going on with labor. But we have newly designed kitchens, way more efficient. And one of the things that we found, for example, is that the way that our equipment was all laid out and the way that the menu had changed over the years, our crew were walking an extra 1.5 miles collectively every hour than was really necessary. So imagine the productivity of rejigging that equipment and the benefit to employees. Also equipment that is much easier to train on. So from the guest experience, they're going to get hotter food served faster and more craveable food. And from this new iconic look, from an employee experience, way easier to use, easier to learn, and pleasant to be in.
And Francis, on the labor topic, I think Bojangles has really set off a discussion in the fast food industry, giving workers a week off to rest up, but they're not paying them. Is that something you're looking at doing just to give employees just a breather, because it has been so busy over the past year and a half?
Well, I would be very remiss at this point not to thank our entire team for their tireless efforts. I mean, it has been a long 18 months for our crew, and we could not be more grateful to them. They're really dedicated people. They show up every day and do a great job. So we're incredibly grateful. We're seeing the labor challenges. We are doing all kinds of things to show our appreciation. We've raised wages like most people. We closed our stores on July 4th because we just wanted to make sure that everybody actually got a day off to celebrate with their families. We believe that people should work when they want to work. So we're giving everybody, obviously, the opportunity to do that. We're one of the first chains to also launch instant pay, which means that if a team member or a manager works, a shift manager works one day, they get paid the next. And that's been a huge benefit for us.
That's interesting. I can't recall hearing that elsewhere in the fast food industry, Francis. So if I were to work at a Checkers right now, let's say a cook in the kitchen, how much would I make per hour?
Our average wage is just over $11 an hour right now. That's obviously a blended rate across the country. We've seen some markets where the wage inflation has gone up by 10, 15%. Other markets, not so much. So it really depends on the supply and demand in the marketplace.
All right, we'll leave it there. Francis Allen, President and CEO, Checkers Drive-In Restaurants. Good to see you. Big fan of your fries. We'll talk to you soon.
Thank you very much. Thanks for having me, Brian.
Looking at the tech names here and the big gains we've seen over the last few sessions, Brent Thill, of course, Jefferies Analyst. And Brent, today we're talking about Netflix hitting a new high on the back of an upgrade. But of course, yesterday it was Alphabet, it was Apple. What do you think's been driving the gains here? Are these individual stories that we're seeing play out with these stocks, or you think we're sort of seeing a cycling back into the high growth names?
Yeah, I think, we took a little bit of a break earlier in the year, and I think we're now coming back. Obviously, last year was a huge year for tech, given, the digital disruption theme. And I think, this is not going to end. We're clearly in a completely different world, in our opinion, a work from anywhere trend, a world where we're being digitally connected by our devices and by this content. And ultimately, I think this is just lack of exciting growth in other places. Part of it is fund managers, don't want to be underweight. A lot of these stories are, as you highlighted earlier, are making up a big piece of the benchmark, and they can't, if they're underweight Google and Google goes up like it did, this year, up 64% year to date, they don't want to be underweight. I think the other piece is valuation. So in software, we're dealing with multiples at 30 to 50 times revenue. Google's trading at 15 times EBITDA. And these are cheap multiples. They're growing EBITDA faster than that. So, that would say, historic kind of textbook finance, like if you can buy a company that's trading below its EBITDA growth, like it's probably a good investment, right? And so Google, it has really benefited. I think some of these, stay-at-home stories, Netflix, Amazon have really underperformed given lofty expectations. And look, we are venturing back out into the world. We are doing more, but I think those stories have been effectively lagging in a big way, and so I think investors are looking at these kind of stay-at-home names, whether it's Zoom, Amazon, Netflix, as 2022 stories, and are looking later in this year to put more money to work back into that sector as the opening trades, right? The Googles, the Facebooks, the Apples have been working better.
Yeah, it's interesting because we saw that big move after Zoom's earnings, and obviously, there's a lot, I guess, kind of signaling maybe some tough comps in keeping that growth rate up. But as Akiko's kind of pointing out, and we heard Jared walk through, with the 10-year back towards 1.3 and expectations ahead. Everyone's, the timeline may have gotten pushed back, but the expectation still rates will be rising eventually here. I wonder how much maybe that delivers a cap to maybe the upside in some of these names if we do see that rotation back towards cyclical.
Yeah, I think, look, that's what kind of ruined the tech party earlier on as rates started to rise. So something to keep an eye on. But ultimately go back to the multi-year journey, right? Did you want to be overweight Google, Facebook, Apple, Microsoft, a number of these names? And the answer is yes. And I don't think the world is changing. I don't think we're going back to the old world and some of these old school industries. I think they're going to matter, but I don't think they're going to matter as much as what's happening in tech. And that's not a self-serving comment because I work in tech. It is a comment that has, driven this for quite some time. And it's been the right way to go. So I believe that this is a continued multi-year shift. And again, we're dealing in internet. We're not dealing with big multiples. We're really not dealing with incredibly large multiples. And I look at, there's some great stories. Like you look at Zillow in the home market, right? This multiple is contracted as home prices have risen, inventories, shrunk, and you look at the multiple correction. Are they going to be in a better position or worse position to understand digital buyers for homes? In 5 years, and I think they're in a better position. And that's one example, but there's a lot of other examples of companies really disrupting these old school industries that I think, you look at even Chewy, right? I was completely wrong on this stock. And as people adopted pets, they didn't go to Target and Walmart for their dog food. They went to Chewy, and that stock has been a home run over the last 2 years. So I think tech is still going to be the way that many of our investors are going to still be parked overweight. It's been the right call. I think it's still the right call to have, again, select exposure. And we don't think this trade's done.
Brent, you mentioned valuations and what you're watching right now. Where do you see the biggest opportunities on that front? When you think about where things stood last year, some would argue that valuations ran way too high, which led some investors to pull back just a bit. What are you seeing right now that you like?
Yeah, I think, look, there's a divergence right now. We have a lot of software companies trading at, 30 to 50 times revenue, Snowflake at 50 times revenue. It's really hard to make stories work like that at 50 times. It's a great company, but, stocks lagged many of its peers this year because of that multiple. Stories that we like right now, we like Iron Source, tickers IS, below 10. It's a recent SPAC, and just full disclosure, right? SPACs have been traded difficultly, but this is a great story serving the advertising economy for mobile gaming and the application economy. A great team. We think that stock below 10. You have to be patient through the SPAC process, but this is a good story. Vimeo is another story we've highlighted. NVIDIA, VMEO is the ticker, $54 price target. Helping, with the video economy. We really like that story. Recent spin out of IAC, extremely well run. Those are some smaller names. In terms of large cap, we still like Microsoft, Google, Facebook, Adobe. These are great, pillars. Intuit's another story that we've highlighted for many years. It's had 13 straight years of positive returns, and we think this story has been, it's up 47% year to date. People are going to pay their taxes. Small businesses need accounting software to run their back office. So those are a few names that we like in our coverage.
Again, you haven't been wrong here, and being in tech has been, a huge thing for anyone who had really leaned into that trade. So that's definitely been the correct answer for years now. But there is kind of one risk that I guess we haven't talked about as much recently because there hasn't been much progress, and maybe that's the point. But when you look at maybe some of the anti-monopoly rhetoric that we've heard about cracking down on big tech, obviously that's been going on in China. But back here at home, politicians maybe not really raising that many concerns as of late. I mean, I wonder how big that overhang is still in your eyes when we talk about maybe breaking up some of these companies. If there is standouts, maybe that the risk seems higher.
Yeah, regulatory is always going to be a concern, and it's something we treat seriously. But what I've said for basically 2 decades covering tech is ignore it as an investor, which means you use this as an opportunity to invest, right? When you had the Microsoft case in the EU case, right? That the stock, was $30 and Microsoft is now $300, right? So did you want to invest in the face of regulatory overhang, right? Mark Zuckerberg a few years ago sat in front of Congress and the stock was below $150. It's $376. So I think, you go back to the playbook we've had is treat it with respect. The regulators are trying to do their job. And effectively, we think these companies will find a middle ground. They don't want to hurt the end user. They want to help. And if there's something the regulators need, they'll do it. I don't think they're broken up. We don't think there's a case. Again, if I'm wrong, what I've said is that you want me to be wrong, because the sum of the parts in Google being broken up between Waymo, Verily Healthcare, their cloud, you go through all these initiatives, the sum of the parts are better, right, than the existing trading. If Amazon broke up AWS, like if Snowflake trades at 50 times revenue, I'm not sure what AWS would trade at, but it's a big multiple and it's higher than where Amazon's trading today. So if they spun out Amazon AWS because the regulators made them, and I don't think that happens, but if you're hoping I'm wrong, because the stock's going to rip, because the sum of the parts is just better than the whole. So the reality is, I think you use this as an opportunity. Every time there's a regulatory scare, again, how many times has Google had a lawsuit from the government and you're up 64% year to date? Facebook, same thing. Like, you just keep going through the case studies. Like, the playbook has worked.
Hey, if it ain't broke, don't fix it. We don't have a lot of guests who will come on here to kick off the show and I'll just sit there talk, but I could listen to that for hours. Brent Thill here, kicking us off today. Appreciate you coming on, man. You got to come back sometime soon. Be well. Welcome back to Yahoo Finance Live. We're watching the action play out here in artificial intelligence company C3 AI. Shares under pressure a bit today after revenue slightly topped expectations, but it was the bottom line that became an issue for the company, reporting a wider than expected miss on the bottom line. That and adjusted earnings per share, loss per share, I should say, coming in at 37 cents versus the 28 cents analysts had been expecting. And for more about the quarter, happy to welcome back into the show the CEO and chairman of the company, C3 AI, Tom Siebel, joins us right now. Mr. Siebel, good to be chatting with you again. Here, I mean, we had talked about this too when you guys IPO'd and you saw the doubling on day one. Growth was going to moderate. But what did you learn about kind of how the company is growing here this time around?
Well, I think we're right on track with what we communicated when we took the company public. So far, we've exceeded expectations every quarter. We're on the growth trajectory that we projected. We have become the world's leading provider of enterprise AI applications. We just formed a very, very strategic relationship with Google Cloud, where the almost 4,000 strong salesperson organization at Google Cloud will be selling all of our applications globally. So that dramatically increases our sales capacity, say by a couple of orders of magnitude. And, I think the company's right on track. And, I don't really watch the stock price day to day. That's not my job. I think as far as I'm concerned, we have $1 billion cash in the bank. We have enough money to do what we need to do. The market can just close for 5 years, and I think if it opens, then all the shareholders will be happy.
Some strong words there. I was going to ask you about the stock move. I know you don't like to comment on it, but we are seeing it under some pressure today. So I just wonder what you think investors are missing in terms of the growth story that C3 AI is on right now.
Well, let's think about this. We deliver 40 turnkey enterprise AI applications today for banking, for manufacturing, for oil and gas, financial services, telecommunications, manufacturing. Google Cloud decided they wanted, and these are very, very high value applications where these companies are realizing billions of dollars a year in annual economic benefit from these apps. Now, the Google Cloud decided that they wanted to change the competitive dynamics of the hyperscaler market and lead with turnkey AI enterprise applications rather than CPU seconds and storage as they compete against the other hyperscalers. And you think about this in terms of they needed to approach a partner who had a portfolio of applications like that. How many doors are there to knock on in the world? There's virtually only one. We're the only company in this business. We're the only, pure play in enterprise application software in the world in applications other than say toys. Like toys would be storage, or toys would be virtualization, or toys would be a machine learning library. We don't deliver toys, we deliver applications. So we're the only company in this game. This is probably a $300 to $400 billion addressable market. And I think we're going about establishing a market leadership position in that space. And that's the big picture. And I think we have 3, 4, 5, 10 years to execute that strategy. If we execute it, this will be one of the great technology companies in the world.
Yeah, let's use that 5-year time frame here then, because I felt like when we were at the IPO stage, right? When was that? A year ago, more than a year ago, right? When we're looking at the growth rate, right? You came on, you're kind of honest about, we're not going to run 75% growth all the time. It's going to moderate a little bit, and we've seen that now. In terms of kind of subscription revenue here, up 29%, total revenue up 29% year over year. I mean, when you look at that 5-year time frame and position it with where the stock's trading now, what is it that you would tell investors about where you'll be in 5 years if all the things pan out, the Google Cloud partnership and also the government contracts that it sounded like analysts might not have been projecting quite correctly?
Well, I think, again, whatever the stock did this morning is, it'll do what it does. And the 29% growth rate would put us in the top decile, certainly, of high growth companies and enterprise application software. The analyst predictions are that our growth rate will accelerate in the coming years. And, I think the company is right on track. It's all good. I think we're very pleased. We're pleased with our Microsoft partnership, our Google partnership, our Baker Hughes partnership, FIS partnership. This company is right on track, and I'm quite pleased with the results.
You've got a pretty broad footprint right now across sectors, whether that's in manufacturing or financials, a long list here in terms of your reach on enterprise AI. Where are you seeing the biggest growth right now? What are you most excited about?
I think in the long run, so today we're huge in energy, oil and gas, energy efficiency, telecommunications, manufacturing, aerospace, defense, intelligence. In the long run, I'm personally most excited about precision health. Precision health will be the largest commercial application of AI, where we will be able to do, very precise disease prediction and therefore be able to intervene clinically and avoid the diagnosis. AI-assisted medicine, genome-specific medical protocols. I think the economic and social benefits that'll accrue from applying AI to precision health are going to be really staggering. People will live longer, they will be healthier, we will deliver healthcare at lower cost, and we will do it. We will be deliver. You're using devices like this. We will be delivering healthcare to massively large, previously underserved communities.
The Food and Drug Administration has called a meeting of its vaccine advisors for September 17th to discuss booster doses of the coronavirus vaccine. It comes just a day after two senior FDA officials resigned over frustrations with the Biden administration's plans to move forward with recommending COVID-19 booster shots without their prior approval. Joining me now to discuss this and more is Dr. Anjalee Rasmussen, virologist with Vaccine and Infectious Disease Organization at the University of Saskatchewan. We're also joined by our health reporter, Anjalee Khemlani. My thanks to you both for joining us. So, Doctor, I want to start with what appears to be this dissension in the medical community about the need and timeline for these booster shots. They're supposed to be widely available starting September 20th. For those who had their second dose of the vaccine 8 months prior, right? Lots of rules there. What is your feeling on that timeline? Do you agree with it?
So I do, and this is something that I very recently changed my position on. Even a few weeks ago, I was not convinced of the need for a third booster shot for the mRNA vaccine regimens. But increasingly, we've been seeing data coming out that does suggest that the mRNA vaccines, and particularly the Pfizer vaccine, is experiencing a drop in vaccine effectiveness in terms of being able to prevent symptomatic COVID-19, both caused by the Delta variant and really any other variant. And this drop has occurred over time. Last week, a paper came out in the Journal of the American Medical Association that showed a head-to-head comparison of the Pfizer and Moderna vaccines, and that has showed a decrease in vaccine effectiveness, again, more with Pfizer over time. Now, this isn't actually that unusual. We do have a number of vaccine regimens that are 3-shot vaccine regimens that do require an additional booster months after the original vaccine regimen. So I think that the data is starting to really support this. I think that the main issue here is that the White House came out and made this recommendation without the general scientific community actually getting a look at this data, and without the FDA's guidance and regulatory approval. So this is really more of a question of who's in charge, who's making these recommendations, and on what basis are they making them, than the fact that they aren't supported. I do think that increasingly this decision is supported by the data.
Now, the FDA is considering whether to authorize a lower dose of Moderna's COVID-19 vaccine for boosters than the dose given in the first 2 shots. Can you explain to us why that is, and why aren't we seeing that happen with Pfizer's shot?
So there's a difference in the dose between Pfizer and Moderna. The mRNA itself that encodes the spike protein from SARS coronavirus 2 is essentially identical between these two vaccines, but the Pfizer vaccine is being given in 30 microgram doses compared to the 100 microgram doses given for Moderna. And that may explain why we are seeing some differences this far out in terms of vaccine effectiveness in the real world between the two vaccines. The reason why Moderna is proposing a 50 microgram reduced dose for the third booster is that a clinical trial has been conducted using that dose. So you don't necessarily need to give as high of a dose. The issue is not necessarily so much the dose of the third shot. It is re-exposing your immune system to the spike protein to really let it know that it needs to lock in those protective memory immune responses to it. So in that case, a lower dose might be more appropriate and also might be less reactogenic, meaning there are fewer side effects. So I think that is the reasoning for approving a lower third dose of Moderna.
Dr. Anjalee here, really good to speak with you again. I'm wondering about the point you made about, we do have some vaccines that are 3-dose courses. Do you think that that's sort of what we're looking at right now, that COVID could be a 3 and done? And if so, what's the potential impact on, say, these theories or ideas that maybe we would need an annual shot against this disease?
I mean, a lot of this really still does remain to be seen. So normally in the vaccine development process, one of the reasons it takes so much longer than the expedited process that we've seen for the COVID-19 vaccines is that they do look at durability, and they usually look at multiple types of dosing regimens so that once it is approved by the FDA, really the optimal dosing regimen is approved. Obviously, this is a crisis and an emergency, and we didn't have the luxury of taking the time to truly optimize this. And I think that's what we're really seeing now. In terms of will we need annual boosters, that really depends on a lot of different things. That depends on potentially the emergence of new variants that are more evasive to these vaccines, although I'm less inclined to think that that's a possibility, given that what we've seen with the variants that have emerged thus far, first Alpha and then Delta, have really outcompeted the other more vaccine or immunity evasive variants like Beta and Gamma. So I think that we may not need to reformulate the vaccine to be variant specific in a year. That would change the calculus as to whether or not we need to do annual boosters. I'm inclined to think that if the virus doesn't continue to spread and doesn't continue to produce emergent variants that are very resistant to the vaccines, that we would probably not need annual booster shots, provided that a third shot can provide this long-term protective immunity that I was describing.
I want to talk about something you said earlier about, the discussion over the FDA and sort of bring it full circle to also include the CDC. I know in general, there have been a lot of discussions about the quote unquote whiplash that's being felt as new information comes in and as the guidance changes. How should we think about all of it put together, including sort of what we hear coming out from the White House and how that is all being played out when it comes to how Americans should really be thinking about how to deal with this disease?
I think that there's a few things that people need to think about. And one is what the roles of the FDA, the CDC, and the White House actually are. And also to consider that this is a generational pandemic, really. This is something that hasn't happened in any of our lifetimes. And so our agencies, like us, are imperfect. We have a new administration that came in the middle of this pandemic, and that has changed the way that these agencies are run. But what really happens is the CDC and the Advisory Committee for Immunization Practices, which is based at the CDC, but includes scientists from the FDA as well as independent scientists from academia and medicine, are the ones who make recommendations and guidance about what we should be doing for vaccines, what other measures we should be taking. The FDA's role in all of this is to actually regulate things. The White House, I think, is trying to lead in a very uncertain time in the face of constantly changing evidence. And they are in touch with both the FDA and the CDC. So I think it's important for people to understand that these three agencies, or really these two agencies, and then the overall executive branch of the government, aren't at odds with each other necessarily. They're trying to figure out how to work together when they have somewhat competing goals. They have different agency missions. And they're really just trying to make the right decision in the face of great uncertainty. The White House has said that their recommendation for boosters was contingent on the FDA actually authorizing that. So what people should understand is that nothing's going to happen without the FDA ultimately authorizing that decision, since they are the agency that is responsible for regulating drugs. However, the White House, the CDC, the Department of Human Health and Services, and the NIH will all continue to make recommendations and guidance. And given that there's just a lot that we still don't know, I mean, it's hard to believe we aren't even 2 years into this pandemic and new data is emerging all the time. At first, especially in early days, that may seem like these agencies are at odds with each other, but really it is just a feature of different agencies with different goals, making different conclusions based on emerging evidence bases.
All right, we're going to have to leave it there, but obviously a conversation that we need to continue at another time. Dr. Anjalee Rasmussen, thanks so much, and our thanks to our health reporter. The Denver-based real estate startup Central is betting that the flexible living trend will stick around long after workers are called back to the office. It currently manages about 3,000 apartments, some of them fully furnished, that you can rent for one night or for several years. Joining me now is the CEO of Central, John Slavitt. John, good to see you here. So talk to us about how Central works exactly, and what cities are you in right now?
Well, thanks for having me, Alexis. So our vision is to redefine home. So if you come to central.com, you can book any length of stay, as you mentioned, from a night to a quarter to more than a year. And essentially, that's the first time that's happened in a network of Class A, premium, urban, best located multifamily apartment buildings. So that's the essence of the offering. we have proprietary technology that enables that flexible booking engine. And on the back end, enables us to flexibly manage that inventory, essentially all of our apartment homes, to offer flexibility to the customer, optimize revenue for the owner, and that drives the whole central business model. We're operating in 7 gateway cities in the US, from the West Coast, Seattle, Los Angeles, all the way to the East Coast in Miami. But we have plans and ambitions to grow in a fairly dramatic fashion over the coming quarters and years.
Yeah, I know you're going to be opening, or maybe you just did open a building in Atlanta. Talk to us about that particular space, and also, are there plans to go international with this?
Yeah, Atlanta's coming soon. West Midtown's a thriving, very cool neighborhood. Star Metals is the community that we're just about to take over and launch. So Atlanta's the newest addition to the platform. We have many other gateway cities in our sights. You can expect to see us in many of the NFL cities over the coming quarters and years.
So are you going to be purchasing these buildings? Will this growth happen through acquisitions? I know that Iconic Capital is a major investor and sort of the money arm behind Central. Talk to us a little bit about how you're going to expand.
Sure. It's going to be through a mix of acquisition and third-party growth. The majority of the growth over time will be through partnerships with third-party owners who want to enhance the flexibility of their asset and obviously increase the net operating income of their asset. So it's a hybrid strategy. The reason we started with the investor group that we have, that includes, as you mentioned, Iconic Capital. It includes Ascendant Capital, the real estate investment firm, Bozzuto Homes, one of the leading owner-operators of apartment buildings, and Highgate, the legendary hotel management company. We put this group together that brings industry knowledge, talent, expertise, distribution. And we created the central PropTech platform that drives any length of stay, all of the IP, the IoT that goes into the buildings, the brand standards. We married that with our first real estate, these 10 locations in 7 gateway cities, because the ultimate way to launch this business is to be an owner-operator. Because ultimately, we succeed when owners succeed. And so the majority of growth will be through third-party deals, but we'll continue to acquire as well.
You know, there are some out there, I'm sure you're aware, who are questioning the sticking power of this trend beyond the work from home era. They say that, you know, housing that caters to both short and long-term renters can be expensive to operate. How are you going to offset those higher costs?
Well, Central is a capital-light business model. So Central is a PropTech platform, essentially. So the aspects of Central are the technology that I mentioned, the flexible booking engine, the IoT standards to make these buildings contactless to access and enter, our brand standards. So Central is very capital light. You know, the real estate growth, again, will largely come through third-party deals with owners. You know, so the model's extremely scalable. In terms of the market, you mentioning that we're getting back to the office, the benefit of the central business model is it provides flexibility. So you're going to have a certain percentage of the community that's staying long-term. You're going to have a significant minority that is living flexibly or coming in for a few nights. So that mix is the product mix that a modern multifamily asset needs to be responsible to the market. But it's very stable and solid from an ownership perspective because you have diversification of lengths of stay. And we think that's the future.
All right, John Slavitt, CEO of Central, best of luck with the expansion plans. Thanks for being with us. Speaking of moving up, we've got shares of Encino on the move today, as after the cloud banking services provider posted blowout earnings. Total revenues for the second quarter up 36% to a record high, helping the company cut its losses. And as you can see there, the stock is up pretty nicely, double digits as a result. Joining us now is Encino's CEO, Pierre Naudé. Pierre, good to have you here. Talk to us about what drove these results last quarter and how you're guiding investors into 2022.
Thanks for having me, Alexis. It obviously was a remarkable quarter. This was a record second quarter for us in the company. You know, we announced the Wells Fargo deal. We've done the US Bank deal. What we're seeing is an acceleration of digital transformation in banking. We transform that heavy middle back office processes to actually make these banks look more like fintechs. And I think the momentum was on our side. You see international growth, 129% year over year. So we're moving from a US-based commercial lending company to a global-based multi-product company. And that movement is showing results here.
You mentioned Wells Fargo, which was burying the lead there, Pierre, because this is a big client for you that you're bringing on board. Talk to us about your relationship with Wells Fargo. And I guess this now means that 2 of the top 4 banks in the U.S. are clients of Encino. The other one
That's
being
correct.
Bank of America, right?
That's correct, since 2017. We're proving to these big banks that packaged software in the cloud is truly providing agility. You can transform your business processes because in the end, the only thing the customer is concerned about is, am I approved and when can I get the money? So they have to be nimble, they have to move faster, make better decisions, and simplify their IT infrastructure. And that's what we're doing with our cloud-based platform. On top of those 2 big names, we've got Barclays in the UK, we've got TD Bank. So we've got a number of these larger banks now, and a brand like Wells Fargo will drive momentum into Europe because it's a recognizable brand.
How do you think technology, and specifically AI, is going to continue to drive growth, especially in your industry in the coming quarters?
Yes, it's great. AI, machine learning, and analytics, if you combine those 3, we are actually launching a number of products under our brand called NIC. That stands for Encino IQ, where we do things, for instance, like portfolio analytics to show the bank what is their exposure, what is their lending practices, to follow regulations more closely. Another one is automated spreading. That's when you take the financial statements of a customer, like an entity, a company, a small business, etc., and analyze that to understand their creditworthiness. Well, we all automate that now by scanning it in, pre-populate these spreadsheet-like tools, and actually provide insights on top of that. A third one that is coming up that I see a lot of promise for and see great interest is commercial pricing and profitability, where literally through math and data and insights, we can tell the bank how to charge for a loan. And we see great interest in those kind of products. It removes the bias of individuals and actually drive a much more accurate prediction of where you should price it.
How does privacy and also cybersecurity play into what you are doing? Because I know you're automating a bunch of things for these banks. You're onboarding customers, loan origination, and other things that the bank needs to do to run smoothly. But how are you doing that and still being sensitive to customer privacy and protecting their data?
We're very fortunate. On day 1, we made a decision to build on the Force.com platform by Salesforce. And as you listen to Mark Benioff, his passion for trust and privacy and data security is second to none. And we're actually a layer on top of that, which gives us access to the best in the world CRM solution, plus a global infrastructure of data centers and a platform that is secure. On top of that, we have processes because we're selling to banks. So we understand exactly what the regulations are and how we have to adhere to them.
Pierre, I know when I was looking through the financials for last quarter, you have cash and cash equivalents totaling about $400 million. That's an enviable position for a company to be in right now. What are you planning to do with that cash?
Alexis, we're trying to expand into Europe. We're building product faster. We're one of the highest spend as a percentage of revenue on R&D. We like to build stuff. That's why we've got a platform. But on top of that, as you see some of the executive and personnel moves we did, we are taking some of our most experienced people to look more at strategy. And we always look at build, buy, and partner. And so as such, we look at some M&A activities. We're not comment on specific ones, but I think there's opportunities in the market. We also look at partnering more deeply by region and country. So I think we've got a fantastic opportunity with a $12 billion TAM ahead of us.
All right, we're going to leave it there. Pierre Naudé, CEO of Encino. And again, that stock up 17.5% after that strong earnings report.